What if I told you that a fall in crude oil prices could impact your monthly expenses, your stock portfolio, your debt funds, and even future interest rates? Sounds interesting, right? But that's exactly what's happening right now. Crude oil prices have fallen below $80 per barrel. And while most investors see this as just another market headline, it has consequences across the entire economy. Stay with me till the end because understanding this one commodity can help you better understand inflation, equity markets, and debt markets. Before discussing markets, let's start with something more important: your household budget. Every family experiences inflation. Groceries become expensive. Travel becomes expensive. Consumer goods becomes expensive. School fee rise. Lifestyle costs rise. But have you ever wondered why? One of the biggest drivers is energy, and energy starts with crude oil. India imports nearly 85% of its crude oil requirements. That means oil is not just another commodity for India. It is one of the most important inputs for the entire economy. When crude oil prices rise, transportation becomes expensive, logistics become expensive, manufacturing becomes expensive. Businesses eventually pass many of these higher costs on to consumers. That is how higher oil prices often translate into higher inflation. Let's make this practical. When inflation rises faster than your income, something important happens. Your surplus cash starts shrinking. The money available for savings, investing, retirement planning, or children's education, or even wealth creation starts reducing. This is why inflation is often called the silent wealth destroyer. Not because it takes money away, but because it quietly reduces your purchasing power. Low crude prices can help moderate inflationary pressure, which means households may be left with more disposable income for future goals. Now, let's move from households to businesses. Many businesses rely heavily on fuel, transportation, and energy. Think about airlines, logistics companies, paint manufacturers, chemical companies, tire manufacturers, packaging businesses, consumer goods companies. For many of these businesses, lower crude prices reduce operating costs. And when costs fall while revenue remains stable, profit margins can improve. Higher profit margins eventually translate into higher corporate earnings. This is where equity investors should pay attention. Over the long term, stock prices generally follow earnings growth. When companies become more profitable, shareholders often benefit. In fact, lower input costs can sometimes lead analysts to revise future earnings expectations upward. And markets often respond to those improving expectations. This does not mean every stock will rise, and it does not mean every sector benefits equally. But for a large oil importing economy like India, lower crude prices generally create a supportive environment for many businesses. Now, let's move the next link in the chain: inflation and interest rates. When inflation remains elevated, the RBI may need to keep interest rates higher to control price increases. But when inflation moderates, the RBI gains more flexibility because it no longer has to fight inflation as aggressively. Of course, crude oil is only one variable influencing inflation. Food prices, currency movements, global economic conditions, and wage growth also matter. But crude oil remains one of the most closely watched indicators. And now we come to the debt funds and bond markets. Many investors hear that lower inflation is good for bonds, but very few understand why. The reason is simple: bond prices and interest rates move in opposite directions. Imagine you own a bond paying 7% coupon rate. Now, suppose interest rates fall and new bonds are issued at 6% coupon rate. Your 7% bond suddenly becomes more attractive. Other investors may be willing to pay more to own it. As a result, the market value of your bond increases. This is why falling interest rates can support bond prices. And this is why longer duration debt funds are generally more sensitive to interest rate movements than short duration funds. So the chain looks like this: lower crude oil, lower inflation pressure, lower pressure on the RBI, potentially lower interest rates, supportive environment for bonds. Now, let's connect everything together. A fall in crude oil prices can influence household spendings, inflation, business profitability, corporate earnings, equity markets, interest rates, and debt fund returns. One commodity, multiple consequences across the entire economy. That is why investors should pay attention to crude oil even if they never invest in commodities directly. As investors, it is easy to focus on daily headlines, but successful investing is not about reacting to every news event. It is about understanding the forces that influence long term outcomes. Crude oil influences inflation. Inflation influences interest rates. Interest rates influences businesses, bonds, and equity markets. Understanding these relationships will not help us predict markets, but it will help us become better investors.